This is part 6 of our 6-part series going through the Mike Company Master Budget Project. The final step in the process is to put together our ending balance sheets. Unfortunately, it is only at this point, if your balance sheet balances, that you know you've done the whole project correctly. The easiest way to make sure you don't skip an account is to, and we set up the problems this way, is to make sure that all of the accounts that you need should be on your beginning balance sheet. So what I'm first going to do to start this ending balance sheet is go back to my beginning balance sheet and simply copy over all of my accounts and the basic format. Put in a proper heading. Our balance sheet is as of the last day of the month, in this case. So for January, let's do a little housekeeping here. All we're going to do is, for almost all of these accounts, we're simply going to link to values that have already been created, similar to the way we dealt with the income statement. So first, the balance of cash. We've already determined the balance of cash on the cash budget. The ending balance of cash in January is $10,000. The balance of accounts receivable in January is the amount of sales we expect that we have earned but not collected yet. That's information we'll have already calculated in the sales budget, part 2 of your sales budget. We had $100,000 worth of sales. You collected $70,000. The remaining $30,000 is the balance that you're owed at the end of January. That's the balance of accounts receivable. Prepaid insurance at the end of January. We know from your selling and administrative expense budget, and we'll go there, that you paid $12,000 for an insurance policy. You expensed $1,000 of it. So the remaining balance that remains an asset to us is equal to that $12,000 cash payment minus the amount that we expensed in the current year, or the current month. Your balance of inventory is your expected or desired ending inventory balance, which you've calculated on your inventory purchases budget. You expect to end January with $13,750. So our total expected current assets is the sum of our four current assets. Your property, plant, and equipment. You began with a balance on your beginning balance sheet of $50,000, but you also purchased some equipment that is on your cash budget. You purchased $20,000 worth of equipment in January. Your accumulated depreciation is equal to your beginning balance on your beginning balance sheet, $20,000. And to that, your accumulated depreciation increases by your amount of depreciation expense. Note I'm using a minus sign because in my beginning balance sheet, accumulated depreciation is a negative number, so my total accumulated depreciation increases to $25,000. So my total property, plant, and equipment is $45,000. My total assets are equal to my current assets plus my property, plant, and equipment. On your current liabilities, accounts payable is an amount that you still owe. That's determined on your purchases budget. You purchased $48,750 worth of inventory. You paid 60%. You still owe the remaining 40% from those January purchases. That is your accounts payable. Commissions payable, if you recall, commissions are paid 1 month after they are incurred by the company or earned by the salespeople. So the amount of commissions expense represents an amount that is owed but not paid yet. So your total current liabilities are the sum of your two current liabilities, the balance of long-term debt. That's why on the cash budget we've already calculated the ending balance of long-term debt for us. The balance of common stock doesn't change from your beginning balance sheet. And your ending retained earnings is equal to your beginning retained earnings balance plus your net income from your income statement minus any dividends. Well, we didn't pay any dividends, so it's minus 0. So your total stockholders' equity is the sum of your common stock and retained earnings. Your total liabilities and stockholders' equity is equal to your current liabilities plus your long-term debt plus your stockholders' equity. And you'll notice that my total liabilities and stockholders' equity equals my total assets. So at this point, because your total assets equal your total liabilities plus stockholders' equity, you should be fairly confident that you get it right. So let's go through it one more time, or two more times actually. First with February. February's ending balance of cash. We go to the cash budget. Your ending balance of cash from your cash budget is $10,000. Accounts receivable you find on your sales budget. Prepaid insurance is equal to your beginning balance minus your insurance expense. Your inventory is equal to your desired ending inventory for February. Your total current assets is the sum of those 4 current assets. The equipment doesn't change. You didn't buy any new equipment. Accumulated depreciation, the value of it increases by your depreciation expense, which steps up to $6,000. So your total property, plant, and equipment balance is $39,000. Your total assets, $107,125. Your accounts payable, you go to your inventory purchases budget. It's the amount of the purchases you made you haven't paid for yet. So in February you haven't paid the $22,550. Commissions payable, it's the amount of commissions you've incurred but not paid yet. Your total current liabilities, $28,050. Your ending balance of long-term debts on your cash budget. Common stock hasn't changed. Retained earnings is equal to your beginning balance plus your net income minus any dividends, and dividends is 0. So your total stockholders' equity is a sum of common stock plus retained earnings, and your total liabilities and stockholders' equity is equal to your current liabilities plus your equal to your current liabilities plus your long-term debt plus your stockholders' equity. Notice again, assets equal liabilities plus stockholders' equity. One last time, ending balance of cash is $49,858. Accounts receivable, go to your sales budget. It's the amount of March's sales you haven't collected yet. Prepaid insurance is equal to your beginning balance minus the amount of insurance you've expensed during the month. Inventory is equal to your desired ending inventory for March. Total current assets, sum of those 4 current assets. Equipment remains at $70,000. Accumulated depreciation is equal to what you started with. The value of it increases by your depreciation expense. So your net property, plant, and equipment is now $33,000, and your total assets are $144,796. Accounts payable is an amount on your purchases budget, the amount of purchase you haven't paid for yet. Commissions payable is equal to the amount of commissions that will not be paid until April. Your total current liabilities is the sum of those 2 Current liabilities, my balance of long-term debt at the end of March, which we already calculated, is 0. Common stock, it hasn't changed any. Retained earnings is equal to your beginning balance plus your net income from your income statement minus any dividends, which is 0 in this problem. Your total stockholders' equity is the sum of common stock and retained earnings. Your total liabilities, your current liabilities plus your long-term liabilities plus stockholders' equity, and you'll see that again your total assets equal your total liabilities plus stockholders' equity. So I'm pretty confident it's all correct. Make this pretty by adding some underlines to indicate where subtotals and totals are made. Same thing with and lo and behold, we have our balance sheet done.